All right, we're going to go ahead and get started now. Looks like we have most people who have joined. Hello, everyone. So welcome to the Beginner's Guide to Commercial Real Estate Investing by Overland Capital. My name is Michael Holman. We also have Ken Holman with me today, and we'll introduce him shortly. Overland Capital is part of the Overland Group family of companies and is the investing arm of the company. You can see on your screen here a few projects that Overland has done in the past. Really, the goal of Overland Capital is to provide investors with a better investing experience. And we believe a big part of that is giving people the opportunity to learn about investing in commercial real estate. We've all heard the phrase, invest in what you know, and commercial real estate is absolutely no different. As I mentioned earlier, Overland Capital is part of the Overland Group, which is a fully integrated real estate organization. It's been around for about 30 years. Just want to go ahead and introduce some of the presenters now. As I mentioned at the beginning, we have Ken Holman with us today. Ken is the president of Overland Group and has over 40 years of experience in commercial real estate. He's developed over $350 million worth of commercial real estate. He also holds just about every top designation you can get in the real estate world. Let me turn it over to Ken to talk just a little bit about himself.
Thanks, Mike. Hey, as you can see from the picture, I'm the senior member of this group and have a few more wrinkles than Mike does, but I'm excited to be here with you today. Hopefully, I can impart some of the lessons that I've learned about commercial real estate investing over the past several decades. So let me turn it back over to Mike to introduce himself.
Thanks, Ken. So I run the investments and finance divisions of Overland Group. So I spend a significant amount of my time working with equity partners and lenders. I'm also a licensed CPA. And then lastly, feel free to ask questions throughout the presentation, and we will do our best to answer all the questions at the end. For anyone who needs help locating that Q&A button, it is at the bottom of your screen. Also, you'll be emailed a copy of this presentation, but you can also view it on our website at overlandcapitalcorp.com and clicking on the education tab. Let me turn it over to Ken to get things started.
Our topic today is going to be Beginner's Guide to Commercial Real Estate Investing, and our goal with this presentation is to kind of present some of the avenues of how you can begin to invest in commercial real estate. We're going to go over some of the highlights of the various property types that you might want to consider, and then following that, we'll analyze a basic commercial real estate investment so you can see how we do it. But let's first of all begin by defining what commercial real estate is so we're all on the same page. Commercial real estate is any real estate used for commerce, which is basically buying and selling goods, products, services, commodities, anything like that. It's easy to see that product types like an industrial facility or an office building fits easily into that definition, but a lot of times we get asked, what about apartments or land? Are they commercial real estate? And the line between residential and commercial real estate becomes blurred a bit when it comes to apartments. Most authorities define residential real estate as consisting of 1 to 4 units, and commercial real estate if the project has 5 or more units. And then as for land, if it's zoned for commercial, then it's considered commercial real estate.
So, how in the world do you invest in commercial real estate? So this is one of the first questions we get when talking with people interested in investing in CRE. You're going to hear me say that a lot. CRE just stands for commercial real estate. There are 4 main ways to invest in CRE. 1, you have real estate securities. 2, real estate investment trusts, or commonly known as REITs. 3, online crowdfunding sites. And 4, direct real estate investing. By far, the easiest CRE investment is to simply go to TD Ameritrade or whatever stock brokerage you use and purchase a CRE-focused publicly traded stock or ETF. While this does allow you to follow the broad CRE market, it is important to note that you've only invested in a security and not directly in real estate. As such, your returns and tax benefits will probably be similar to other stocks and not direct real estate investments. The next option is to invest in a real estate investment trust or REIT. So investing in a REIT is actually very similar to investing in a public real estate security, except that a lot of REITs are private, so you won't find them on your stock brokerage anywhere. A lot of times you have to go to that REIT's actual website. Returns are generally similar, really just higher than publicly traded real estate securities. That being said, I do have to acknowledge some REITs have done very well during certain periods. So just keep in mind that, like publicly traded real estate securities, you do usually miss out on some significant potential returns and tax savings. So online crowdfunding. Online crowdfunding sites are really the newest CRE investment platform. These are sites like Fundrise and Realty Mogul. There's a bunch more out there. So these are fun sites to look around on. And the good news is that these sites usually have a standard investment presentation. So all of the investments being offered will be fairly easy to navigate. These platforms can be really a great way to get started investing in CRE investing. But there are two major issues or things just to be aware of. Really, the first is that most of these sites are one step removed from the actual investment, meaning that they insert themselves between you and the investment and usually take a hefty portion of the returns and benefits. For example, a real estate investment might make 15% return overall, but the online platform keeps 6% of that return, leaving only 9% return for the actual investors. Secondly, the sites that do let you invest directly into a CRE investment, which there are only two that I know of, usually have less than desirable investments on there. Not saying all of them, because you can definitely find a diamond in the rough there. But really, because if a CRE investment group needed investors, this is a pretty expensive option. So it's usually not their first choice to go to a site like this. Therefore, a lot of the projects on these sites are there because the sponsor didn't really have another option. Lastly, there is direct real estate investing. This is where you directly invest into a real estate project. So unlike securities and REITs, you get all the potential returns and tax benefits that go with investing in CRE because you are an actual owner of the project. Another benefit of this investment type is that you don't have any middlemen taking huge portions of your return usually. Now, that being said, understand that there may be more risk involved with this type of investment. And simply that's because there's not a third-party company inserting themselves into the equation, right? It's usually you dealing directly with a sponsor or a developer or someone like that. So there's a level of trust that needs to be had between the parties. But on the flip side, there's more to gain because of that.
And direct real estate investing, that's where Overland Capital plays a lot in that market. We love direct real estate investing, but there's basically 6 types of commercial real estate you could invest in. The first 4, apartments, industrial, office, retail, they're all considered core commercial types. However, some people also like to invest in hotels, which is called hospitality, and then other types of specialty properties. I think apartments are everybody's investment sweet spot these days, and for good reason. I've just went to a seminar, and man, they were really high on the apartment market. But they're relatively easy to understand, and they provide great long-term returns once the property's stabilized. Lenders also like this asset class, so it's easier to get a loan, actually. They also have the added tax benefit of being able to be depreciated over a shorter useful life of 27 and a half years. instead of 39 years for most commercial properties. And most beginning real estate investors like to start here in some form because it's a product type that they really understand. And because apartments have so many tenants, appreciation and the value of the asset over time is very predictable. They also tend to do well in good times and even better during economic downturns. That's, I guess, because fewer people can afford to buy homes at that time. Well, Mike will talk a little bit more about this, but there are basically two ways to enhance your return when you're buying an apartment. You can buy an older apartment and fix it up, which enables you to raise the income, or you can build new. So if you're willing to go through the construction and rent up risk, you can usually get a significantly higher return on building new because institutional investors like to buy new properties and they'll pay a lot more than it costs you to build once you get the property stabilized. I've even heard that some institutional investors now are buying these properties at C of O rather than even waiting for them to get stabilized. So industrial is also one of the hot spots these days. Industrial is really divided into 5 categories: manufacturing, warehousing, distribution, flex space, and self-storage. And manufacturing, warehouse, and distribution facilities, they're generally where the big boys play. These properties cost millions of dollars and can have several 100,000 square feet of space. Amazon's really driven the distribution space lately with its need to get products to their customers quickly. However, 2 areas of opportunities for beginning investors is flex space and self-storage. Flex space is like taking a smaller industrial building and dividing it into several office warehouse units. Startups, .coms, subcontractors, even churches rent this space. It's called flex space because the partitions between the units are flexible and can be moved to accommodate a tenant that needs either more or less space. And self-storage, which is an area that we're very familiar with, is very popular these days because it's another asset class that every investor sort of understands. These facilities operate a lot like apartments, except the leases are for a shorter period of time, usually month to month. So flex space, self-storage, those are 2 areas beginners and beginning investors could get into. Large office buildings are popular among institutional investors, especially for marquee type properties. They can be categorized in 4 different ways: by quality of space, ABC, by height, by use, by location. So there's different ways to categorize these, but with more employees working from home and becoming more mobile these days, the need and function of office space has changed quite a bit. Some beginner investors, they'll buy a small office building and become one of its tenants. Years ago, my son Jeff and I bought a small 6,000 square, 2-story square foot office building in Farmington, Utah. And we started out by renting the space to several tenants with Jeff's legal firm taking one of the spaces. But over time, we had a couple of these tenants just kept wanting to take more and more of the space. So we financed this building with a SBA loan, and it's been a very good investment. I see a lot of doctors and dentists that like to do this. Retail, it's probably seen the biggest shift over the past several years with the advent of Amazon and other online delivery companies. But this has caused a lot of retailers like department stores to shrink in size. They need less bricks and mortar. Companies like Borders Books and Toys R Us and a host of other companies have really been affected by this change. On the other hand, we've seen a ton of new entertainment facilities and restaurants pop up as consumer preferences have changed. Retailers are adjusting, but it hasn't been an easy transition. I've seen some investors do quite well when they get involved in this type of property. For instance, one guy, a buddy of mine, bought a defunct retail property and then repurposed the asset. Uh, he bought it for $4 million. It was pretty much vacant, a vacant retail strip mall. But then he renovated it and he found a couple of new tenants, and man, he just got it appraised for $12 million. That's a pretty good bump. But for instance, we took a 25,000 square foot vacant Staples building. This was located in Helena, Montana, across the street from a Walmart supercenter, and we leased it to Big Lots. They needed a 30,000 square foot building, so we blew out the back wall and expanded the space. They then signed a new 7-year lease with 5-year options to renew. And over the years, we've also developed and bought several single tenant properties and leased them to companies like Family Dollar, Dollar Tree, Dollar General, O'Reilly Auto Parts, Walgreens, and others. Maybe some of you don't realize that all of those are tenants in properties that are owned by other investment groups. People with self-directed IRAs and 401ks seem to really love these types of properties because even though the returns are a bit lower than some of the other asset classes, they're really safe investments. And hospitality is a fun space to be in, but generally takes more capital. I didn't list out all the different types of hotel properties that are out there, but years ago, I managed a small boutique hotel in downtown Salt Lake. One afternoon, Harrison Ford pulls up, parks his Harley out in front of the building, and comes in and rents a hotel room for the evening. He was on his way to his ranch in Wyoming and just needed a place to stay for the night. So that was kind of cool.
Hey, I have to jump in here. Is it bad that the first time we talked about this, it took me a second to realize who Harrison Ford was?
Oh my gosh.
I'm sorry, not my era, but
You, you
over
missed the whole Star Wars era, it sounds
I
like.
I know I'm a little bit after that time, unfortunately, but
Man, you missed out, but I can tell you most of the people that are probably on this uh, know who I'm talking about. So
I'm sure they do. They're probably all smarter than I am too, to be honest.
I don't think so, but we see a lot of investors, larger type investors who specialize in hotels, and they get great returns. But about the only way a smaller investor can get into one of these type properties is through a syndication. A good hotel can really be a cash cow, but with nightly rentals, they're pretty management intensive. And the last category is specialty properties. That refers to any special use, special purpose type commercial real estate. Things like car washes, theme parks, bowling alleys, golf courses, marinas, theaters, churches, they're all called specialty properties and fit into that category. They can be great investments for beginner investors because some require a smaller capital commitment. I had a strip mall that had 2 churches as tenants, and they were awesome. They never missed a payment, and they used the parking mainly on evenings and weekends, so that left it available for all the other retail tenants. I see these new drive-through car washes. A lot of those are really killing it. But I wonder how good the property will be if the market moves away or in a different direction from those style car washes, because it would be tough to find another tenant for a property like that. But anyway, the point is there are many different investment opportunities out there for smaller beginning investors. in almost every asset class if you know what you're looking for.
So really there are four main categories of CRE investments. You have core, value add, opportunistic, and development. We're going to go through each one of these in detail. Core investments are the least risky investments because these projects are usually stabilized, fully leased, cash flowing properties. So these are going to be your smallest annual returns, usually range from around 7% to 15%. This would be something like a newly built apartment project that is fully rented and has good management currently in place. Um, on this next slide, this is an example of one that we did. So we purchased a brand new Family Dollar near Salt Lake, just north of Salt Lake, and it's been great. But came in, didn't need any renovations, had the lease in place, management had been good, property was in good shape. And that's been a great investment for us. But kind of as I mentioned, it is lower returns because you're not doing anything to add value. You're simply just taking the cash returns. Value add investments are properties that have cash flow, but there are opportunities to increase that cash flow over time. So the most common ways to increase cash flow are through property improvements, repositioning the property, or improving management and operations. So these are very common CRE investments, and returns usually range between 11 and 17% on these types of investments. You'll hear value add as you get into things all over the place. So an example of this would be like a 20-year apartment project. Maybe it's 3/4 of the way rented and really has never been renovated. Management might also be subpar in this scenario. One example that we have from our company is we have this Broadway Towers. This was a high rise in downtown Salt Lake. So we bought it and ended up renovating it and turned out great. We actually, in this example, we actually took it from apartments to condos. But by doing that, we created really a lot of value through that property. Next, you have opportunistic investments. These are very similar to value add. Really, the main difference is they're generally considered a step up in risk. So these are properties that need significant rehabilitation or are oftentimes completely vacant properties. So annual returns are usually a couple percentage points higher than value add. Another example here, we're going through this apartment theme. You have an apartment project, maybe it was built 30 years ago, but it needs significant renovations. I mean, maybe we have to tear down one of the building or part of the clubhouse or, redo pools. You need to rebuild these things, because of this, project might only be a third rented at the time. That's kind of where we start going into the opportunistic. Ken gave this example. So, this is that Staples, right? So we had that Staples. We had to renovate. We had to put 5,000 more square feet into this, get a new lease on it through Big Lots, and that's really an example of our. Sorry, Ken, did you want to jump in?
I was just going to say, hey, that deal's throwing off about 9% cash on cash, so I feel fairly good about this deal.
Yeah, no, I mean it's a great deal, and total return is up there. I haven't checked them, but I would imagine they're in the mid-teens, especially with a good cash on cash. So lastly, there's development investments. So this is an investment that goes from raw land to a stabilized property. Some people like to classify this under opportunistic investments, but I personally like to separate it because I feel like there's some big differences. Development investments have the most risk of the four investment types. On the flip side, they also enjoy the most potential return. So it's not uncommon to see development investments that range from 18 to 20+% in annual returns. So example of this, purchasing raw land, developing and constructing a brand new apartment project, and then getting it rented up. So this is another example of this. This is one of our projects in southern Utah that's actually currently under construction. And you'll see this is just a development project, right? These are renderings. It's not constructed, and we bought the land. We're constructing it. We raised the money. We're gonna rent it up, and we're trying to get our investors that 18 to 20% return on that.
Yeah, we raised, I think, 6 million on that project, so that's a pretty good
Yeah.
deal.
Yeah, that one's going really well. So now that we understand how to invest in CRE, we understand what kind of investments there are. Let's turn to a few important things to note when you look at your next potential CRE investment. Cash flow history and projections are a key component of almost all CRE investments. That's because most investment firms use the cash flow model, which determines a project's feasibility, investor returns, and potential sale price. So here's a simple outline of how cash flow is usually calculated. You start with gross scheduled income. So this is the money that would be received if the project was 100% occupied. You then subtract the vacancy from that number to get to effective gross income, or EGI. This is the total amount of revenue actually received after subtracting operating expenses from EGI. You get your NOI, or net operating income. Circle this number. So NOI is extremely important, and you should always pay attention to how that number was derived. Like I said, that's the number that your potential sell price is going to be calculated on. That's the number that when you go to sell it, when you go to refinance it, other investors, buyers, lenders, they are all going to look very, very heavily at that NOI number. So that's one thing that you want to make sure you understand, how that investment that you're thinking about investing in is getting to that NOI number. Finally, we just take out our debt service, and that gets us to our net cash flow number. Really the beautiful thing about CRE investing is you get to leverage your investment. So when you invest in CRE, it is likely that the investment is leveraged 2 to 3 times the amount of investor cash put into the deal. For example, we just started construction on a $24 million apartment project. That's Coyote Creek, the one you saw above. That's in southern Utah, where 75% of that debt was debt and only 25% was equity. Like Ken said, we raised $6 million in equity capital. We got an $18 million loan, so we're able to build a $24 million project. So have you ever tried to leverage another type of an investment, say a stock? you can do it, but as you're going through the process, there's usually big bold letters, stars everywhere that basically says do not do this. And really that's because that's viewed as an extremely risky investment. On the flip side, when you invest directly in CRE, you're an actual owner to a real piece of property, and lenders love that. They want to give you their money to build apartment projects or to buy, retail projects. They want to give you the money to do that. That's not the case when you're dealing with stocks or a lot of the other type of investments out there. And then lending parameters. So those really vary depending on the asset class and type of CRE investment. In general, most banks will lend you between 60% to 80% of the total project cost, depending on the project. That really amps up your returns and is one of the big reasons you can achieve such amazing returns in commercial real estate.
I have a little story I probably shouldn't share, but I will on trying to leverage stocks. I thought I had a pretty good stock portfolio, so I went into my bank one day and said, I want to borrow some money against this portfolio so that I can buy more real estate. And by the time I got through the discussion, they were going to lend me 50% of the value at a rate that was significantly higher than I was earning on my stocks. It made absolutely no sense. And then they wanted to keep all the stocks in the portfolio and wouldn't permit me to trade anything without getting their permission. So I finally said, well, maybe that's not a good idea. So when we're talking about leverage using debt, I wanted to just make this point about why real estate is such a great investment. Positive leverage occurs when you invest funds and achieve a return on your investment that's higher because of the cost of the borrowed funds. So look at this little example. I don't want to get in the weeds too much, but say you've got a $600,000 property that throws off $48,000 a year in cash. That gives you an 8% cash on cash return. That's with no debt. Now say you go borrow $450,000 and you pay 22.5, which is 5% in a annual kind of debt service. That means that your $150,000 that you actually have in equity in that deal is throwing off $25,500 a year. That's a 17% return. That's what positive leverage is all about. So now that you know the cash flow model, it's pretty easy to analyze an investment. Almost all commercial real estate investments use some form of the cash flow model when they're being analyzed. And one metric that's used by all commercial real estate brokers, appraisers, and investors, and you probably heard this term or know a lot about it, is the capitalization rate, or in short, the cap rate. The cap rate's used to identify the return you can achieve on an investment. Cap rates are both a measure of risk and return, by the way. Usually the higher the cap rate, the more risk involved, but also the higher the return. So for instance, a building like a Walgreens that is a tenant will sell at a lower cap rate than, say, a mom and pop store, because Walgreens is a Fortune 500 national credit tenant, and there's more risk with the mom and pop store. So commercial brokers and appraisers can usually tell you in a general ballpark range the cap rates for each asset class because they use it every day. The cap rate is the ratio between the net operating income, which we talked about in the cash flow model, and the current market value or the purchase price of the property. So it's calculated by dividing the NOI by the market value or the purchase price. And in our example above, if the NOI was $48,000 and the purchase price was $600,000, the cap rate would be 8%. Cap rates don't consider debt because every borrower has a different capacity to borrow money. And here's how you calculate the formula. There are three variables. I stands for net operating income, R stands for cap rate, and V stands for value or price. If you know the net operating income and the price, you can calculate the cap rate. If you know the net operating income and the cap rate, you can determine the value of the property. So some people call this the IRV formula. It's called the IRV formula basically because it divides the I by the R, and that equals the V, which spells IRV. You can see I've thrown out here a few general rules of thumb for cap rates. When you use a cap rate to analyze different properties, try not to mix the property types because each property has a different cap rate range. But compare apartments to apartments or office buildings to office buildings. As you can see, apartments and triple net retail generally have the lowest cap rates because they're considered the less risky, and hospitality and specialty type uses generally have a higher cap rate.
So in most CRE investments, there are really three elements that drive returns. So these are cash flow, which we spent a lot of time talking about, principal pay down, and appreciation. So cash flow is the most obvious return element of a CRE investment. I mean, it's just simply the cash you receive from the operations of the project. Everybody understands it. Most people get cash flow. They understand how it works. Next, you have principal pay down, and although less obvious, principal pay down is usually just as important as cash flow. Your tenants provide you income to pay down your debt. So while this element isn't immediate, I can promise you, you'll be happy for principal pay down once it comes time to refinance or sell, because you're going to capture all of that value and it's going to come to you. Appreciation is the final return element of a CRE investment. So like principal pay down, you usually don't see the benefit from appreciation immediately, but this is, again, a huge factor when it comes time to refinance or sell a project. Once again, the three items that are going to drive appreciation in CRE, that's going to be inflation, capital improvements or renovations, and increased demand. And I just want to, once again, kind of hammer home the point on how important it is to consider all three of those things. I mean, in some of our development projects, the cash flow is quite low, right? You might be sitting around, 6-7% cash flow every single year, but it's important to understand the entire project, because that same project, might have an overall return of 20, 21, 22%. But because you did a development, most of the return in that is all the appreciation, all the value you created from developing the project. So it's just, you need to understand really those relationships, right? Some are going to be more cash flow heavy. Some real estate investments are going to be more appreciation heavily. Principal pay down is just kind of sort of a function of what happens throughout the project, but make sure you understand the relationship between those three items and understand how to apply it to each real estate investment.
Yeah, usually the more you leverage a property, the lower your cash flow. So anyway, so let's talk a little bit more. I'd like to drill down on a little bit on how appreciation works. It's not something that's usually discussed in an investing presentation, but it plays such a critical role in the overall return that you can achieve that I just felt like it's worth mentioning here. For apartments, multiple tenants and shorter lease terms allow you to increase rents annually, and that gives you a more consistent rise in the value of the asset each year. Industrial properties, office buildings, retail properties, they all have longer lease terms, usually from 5 to 10 years. And if there's no annual rent escalation clause in the lease, the income will stay flat over the lease period. And what that means is then the property value will only go up as the income goes up. That's unless the cap rates fall, obviously. But so let me give you a quick example. We found a Family Dollar store in a great location that was selling at a 7.5 cap. And since most Family Dollars are priced around a 6 cap, we wondered why this was priced lower and had a higher cap rate. So come to find out, there was only 3 years left on the lease, and the owner wanted to sell the building before the option renewal date. Sales had been a little slower on that property, and they were concerned that Family Dollar wouldn't exercise their option to renew the lease. So we decided to buy it, and I told our investors that I thought it was a great investment because of the location. And if Family Dollar didn't want to renew the lease, I felt like we could probably find another tenant that would pay more than Family Dollar was going to pay. So we decided to buy it, which we did, and they've got another year before they renew their lease. But last year, they took that Dollar Tree, took that Family Dollar, who owns Dollar Tree and Family Dollar, and they converted it to a Dollar Tree. And now it's doing much better. It was a better fit for that market. And we'll see in a year if they renew the lease. If not, we'll find a tenant who will pay us more. And heck, it's a 6,000, I guess it's about a 9,000 square foot box. So how tough can it be to lease that out? Here's a simple profile to show you the property appreciation of each property type. Apartments show a steady incline over time. That's one reason why everybody likes apartments. Industrial properties have a stepped up appreciation profile. That's based on lease terms, depending on the number of tenants that you've got. Office does the same thing. It appreciates on a stepped up basis, but that depends on the number of tenants you've got there too. So the more tenants, the more likely the appreciation profile will be a more consistent incline instead of stepped up. And then on retail, that can have either an incline profile or a stepped up profile. If you have a single tenant and the rent doesn't go up for 10 years, then the property value won't go up until the tenant exercises its option to renew the lease at the higher rent. So since appreciation is a major component to your return on investment, it's, in my mind, really important to understand how the income stream affects the value of the property. So now let's look at how you come up with an internal rate of return. This is kind of the culmination of the presentation in effect, but internal rate of return is the measure of the investment's overall return, taking into consideration the cash flow stream, the reduction in loan principal, and the appreciation in the value of the property. It's called internal because it excludes external factors like inflation, cost of capital, and other financial risk things. So many seasoned investors use the IRR to compare one investment property to another. This is where you can compare an apartment investment to, say, an office building or a retail property. And the first step is to determine the annual cash flows for each property. So let's imagine here that we're buying a 6-unit apartment building for $600,000 and we're going to borrow $450,000. That means we've invested $150,000 in cash. And the cash investment of $150,000 in the IRR model is shown as a negative because it's an outflow of cash. And then we show the annual rent cash flows as positive numbers, and they start at $9,900 and go up to $18,600. So if we were to take the next step in the calculation of the IRR, let's say that the NOI has gone up 3% a year, and so started out at one number, but now it's risen to 55,600, and say it started at 48 or something, but now divide that by the 6% cap rate, and which is pretty typical for apartments, and you get a value of 925,000. That gives you an increase in value of 325,000 over your original $600,000 purchase price. Then step 3, you calculate the loan amount at the end of year 5, and in this case, it went from 450,000 down to 400,000. That gives you an equity increase of $50,000. And step 4, you then simply add the increase in the value of 330,000 plus the reduction of the loan amount of 50,000, and that gets you an appreciation in value of 380,000. And then you just simply take step number 5, which is add the cash flows and the appreciation to get the total cash flows that calculate the internal, and then you just calculate the internal rate of return using a financial calculator like a HP 10B2 or an Excel IRR formula.
Yeah, let me jump in here and say use the Excel formula. In case you're
Yeah,
wondering, it's a whole lot easier. That HP 10B2, that takes me back to my days in college, is getting a master's of accounting at the times when they wouldn't let us use our computers, so we had to use those financial calculators. It's not difficult, but I always give Ken a hard time because every time he wants to calculate the IRR, he's pulling out his financial calculator, and I'm
Mike,
pulling out Excel.
I've graduated from an HP 12C to an HP 10B2. Don't give me a hard time about that. So in this case, the IRR was a healthy 26.88%, even after you deduct things like depreciation recapture and capital gains tax, which is beyond the scope of this presentation. You still have a solid return in excess of 20%. So I hope we didn't get too deep in the numbers for anybody, but whether you're a beginning commercial real estate investor or a seasoned pro, you can use this approach to analyze most commercial real estate investment. So I'd like to thank everybody for taking the time to come. And I'd also like to thank Stephanie, who's sitting here beside me. She's the one that really put this presentation together for us. So thanks, Steph. Now I'll turn it over to Mike to wrap up.
Perfect. Thanks, Ken. So I just want to say thank you all for joining us today, coming to the Beginner's Guide to Commercial Real Estate Investing. I hope that everyone feels a little more confident the next time you look at that commercial real estate investing. One of the main things I want to point out and throughout this presentation is we really want you to feel comfortable with CRE investing, right? And a big part of that is simply understanding these basic items, right? I mean, a lot of times you get talking to a real estate sponsor and they're talking about NOI and cap rates and IRRs and equity multiples, and it's enough to make, your head spin. And they just do it because they're in it each and every day. So I hope everyone can just take some time, right? And go ahead and learn some of these things because the investments that they do, I mean, we have a lot of investors, right? And some of these investors have done extremely well investing in commercial real estate. So go ahead, take the time to learn. And then also on the flip side, don't get analysis paralysis, right? If you're thinking about investing, at some point you got to take the leap of faith, and you're not going to know everything. Just try to make sure you know enough, right? And really that's it. So thank you all once again for joining us. We're going to go ahead, get into the Q&A right now. Once again, that's at the bottom. Go ahead and answer that poll that pops up on your screen as well. It just lets us get to know you a little bit better. So we'll go ahead and get started answering some of these questions. Like I said, go ahead, type it into the Q&A if you got any questions. We're happy to answer anything. So Gordon asked, where can I rewatch this? Gordon, we are going to email you a copy of this webinar, so you'll get it in your email. Also, you can go to Overland Capital's website. That's that website there on the bottom left of your screen right now, www.overlandcapitalcorp.com, and go ahead and click on the education tab. It usually takes 2 to 3 business days to get the webinar up on there, but you can go ahead and rewatch it there. All right. Well, it doesn't appear that we have any questions right now, so we'll go ahead and give everyone just another minute or two to formulate their questions if they have them. And for anyone who this is their first time, just while you're typing these questions, I just kind of want to reiterate, this is really where the value of these webinars come in. I mean, you see other webinars, other investing platforms, right? People trying to educate you on investing. And a lot of times it's just spewing out information. The reason we wanted to do this is we wanted to really get on the same level with all the people that we talk to on a day-to-day basis and all of our equity partners and potential equity partners, right? So this is the opportunity to really ask those questions. There's that saying, right? There's no such thing as a dumb question. Trust me, we understand. Okay. Oh, perfect. So, David, I want to go ahead and answer this question from David. David asked, is there a way to get into commercial real estate when you do not have much money to invest? Ken, do you want to take this, or do you want me to take
Yeah,
this one?
no, I'm happy to take it, and then add what you think is relevant. But
Perfect.
so the way we do most of our investments, and I was going to mention this a little bit in the presentation, but I didn't. We generally form a limited liability company, and then that operates a lot like a corporation where you can sell units similar to shares in the investment. So we can take smaller investors, or you can, if you're doing a deal, you form an LLC, and you have to follow some legal parameters when you're doing offerings because they're regulated by the SEC, but there are attorneys out there that can help you do that. But that's the way for a smaller investor to get into a project is through that mechanism. It's called a syndication.
Yeah, perfect. That's really where I would suggest you start too. So, if you're looking to invest directly, I would find a company that does real estate syndications, and or um, and or look at potentially one of those crowdfunding websites. Some of those will have smaller investments as well. So, go ahead and look at those. Look at those options. Most investments will have a minimum investment, right? And that really ranges anywhere from $5,000, $10,000 all the way up to 100, 150, $200,000. So each investment is really different. But those are really your best spots. We won't get into it too much here, but also make sure you understand the difference if you're a smaller investor between accredited and non-accredited. We're actually probably planning on doing a webinar um, there here in the future, just kind of discussing the difference between accredited and non-accredited. But that's a term
Yeah,
you're going to see. So I suggest just do a Google search. There's lots of information on there,
yeah,
or stick around. We'll talk about it in a future webinar.
right. Mr. Tolton, uh, I
Oh,
wished I could pronounce his first name NJ, so I apologize for
and
not knowing how to pronounce that, but
hey, and I'm going to apologize, NJ, if this is a Mrs. Tolton as well. So.
great. So, do you do Reg C or Reg D investments? That was a question that was asked. And we do primarily Reg D offerings. Uh, though that's Regulation D, uh, uh, based on the Internal Revenue Code. And most of our offerings are either a 506B, which permits accredited and non-accredited investors, or a 506C offering, which is only available to accredited investors. An accredited investor is somebody that has a net worth of $1 million, in excess of $1 million, excluding their primary residence, or they make $200,000 a year annually. And if it's a couple that's investing, then their annual income has to be 300,000 together. So
Perfect. And Miss Tolton, thank you for clarifying that.
oh man, I re I really put my foot in my mouth there. I
Uh,
apologize for that.
okay. We're gonna go ahead, keep going. So Danube, yes, looks like you got on a little late. I'm sorry. Apologize for the confusion on the time with you. We will email you a link. Everybody's going to get emailed a link to rewatch it. Once again, that website on the bottom left, www.overlandcapitalcorp.com. You can also go there, and this webinar will get posted. And go to the education tab. This webinar will get posted there in the next few days. Okay. Next question. What platform do you offer for syndication with Overland? Great question. So we do all direct investments. So currently, most of our projects that we get investors on are single asset projects, right? So we'll do one apartment project. We'll bring in a bunch of investors into that one apartment project, and we'll do that single deal. We have an investor portal that you can get get on, see your information. And this person asked anonymously, so we're happy also, offline to answer any more in-depth questions you may have about Overland. If there's anything else you want to add, anything else, Ken?
Nope, that sounds great.
Okay, perfect. So next question, we have it from Glenn. He's asking us to explain cash on cash return and how it relates to the total returns you get from your investment. So I'll go ahead and take a first pass of
Sure.
this and let Ken add anything else that he wants. So when you look at your cash on cash return, this is the cash that you actually get, and that's really only part of your return, because in part you have to consider, when you sell or refinance the project, that you're paying off less debt because you've been paying off your debt over time, and also that hopefully your value has appreciated, and so your asset is simply worth more than it was back when you made your first investment. So that's why you have to take the holistic approach to looking at all three of these. A lot of times, we've had this in the past. We'll talk about it. We'll go through everything. We'll show an investor, hey, this is going to be a 20% internal rate of return IRR project. It's going to be great. And then they come back and they're confused because they're only getting, maybe 5, 6, 7% cash on cash return. And it's usually just an explanation of a process that says that, that's part of it, but there's also these huge parts with appreciation where your value is worth more than it is now, and where you have more equity in the deal because you've been paying down debt. Anything you want to add to that, Ken?
Yeah, I just wanted to say, don't confuse net operating income with net cash flow. Net cash flow is what you use to figure your cash on cash return. Net operating income is before you add your mortgage payments, and net cash flow is after you paid your mortgage payments. So you take the net cash flow, divide it by the amount of money you've invested, that gives you your cash on cash return. And surprisingly, it's usually around 3 to 6%, somewhere in that range. Sometimes you can get a little higher than that after the project seasoned a little, and then your principal pay down is almost equal to that, another 4, 5, 6%. So with most commercial real estate investments, you wind up getting about 8 to 10% return, maybe even a little higher than that, up to 12%, before you even start talking about appreciation. So
perfect. Thanks for that. So I'm going to jump over to the comments here. We got a question from Brian. So Brian asked, what is the status / project schedule of your Mesa, Arizona self-storage project? Thanks for asking, Brian. I'll just give a really quick answer. So we are fully subscribed at that point. So all the equity capital has been raised, and that project is expected to start construction here in January. If you have more specific questions, we're happy to answer them. Go ahead and email this email on the bottom left of your screen, investors@overlandcorp.com. If you have questions about specific projects, we're happy to answer those.
yeah.
Next question from Mary. Do you do 1031 exchange? Ken?
Yeah. Mary, we love 1031 exchanges, and we do a lot of them. So, and we're one of the few companies that I'm familiar with that have figured out how to take 1031 exchange investors, individual private investors, and self-directed IRA and 401k investors, and put them into the same investment. And so, yeah, we do a lot of that. And in fact, we got a project coming up in December that we're going to be rolling out that will include a lot of 1031 exchange investment capital, particularly on the land acquisition side. So you have to do a like kind exchange, obviously. So we usually use that to for the land acquisition, which qualifies the 1031 exchange.
Perfect. Thanks. So that looks like all of the questions. We're going to go ahead and get things wrapped up. If anybody wanted to ask a question, you didn't get the chance, go ahead and email us over on the left side of your screen, bottom left, that investors at overlandcorp.com. We'll go ahead and get all your questions answered there. Submit your questions. We're always happy to talk, always happy to chat. And we're really excited for everyone here. We've seen, I think Ken and I in both of our careers, we have seen the power of commercial real estate and
Yep.
seen the power of investing in it. And it's we're kind of on a mission to make sure that everybody knows about this. It's so foreign, and it's a little more complicated, but it is so powerful. So thank you for joining. Appreciate all of your questions, all of your participation, and we'll see you on the next webinar.
Thanks.